Hello, folks. Today we've got a global story with big implications. Former US President Donald Trump has offered to mediate between nuclear-armed rivals India and Pakistan over the disputed region of Kashmir. This isn't just diplomacy, it's a power move. On May 11, 2025, Reuters reported that following a tentative ceasefire, Trump posted on social media, "I will work with both to see if, after 1,000 years, a solution can be achieved regarding Kashmir." India, long steadfast that Kashmir is exclusively its territorial matter, rejects third-party mediation. Pakistan welcomes the US move. Here's what this means. Power. America reasserting global leadership. Economy. If peace holds, trade links with India and Pakistan might open. Risk. If mediation fails, the US could be diplomatically isolated in South Asia. Strategically, Trump's proposal is both bold and risky. If accepted, it positions him as a peace broker in one of the world's toughest conflicts. If rejected, it could still embarrass the Biden administration for lacking initiative. Experts at the Brookings Institution note, every Trump statement in foreign policy is a chess move calculated to draw attention, challenge Washington, and dominate the narrative. Media analysts agree. This is classic Trump turning diplomacy into theater, making headlines with a single sentence. Bottom line, Trump's offer marks a moment, but not the finish line. Watch closely how India and Pakistan respond, and whether America truly steps in. Drop a comment. Should the US mediate? Why or why not? Here's a breaking news story from Geneva, Switzerland. The world's two largest economies, the United States and China, have agreed to a temporary deal to defuse their bitter tariff war. And if you're in the United States or following global markets, this news has implications for your wallet, your jobs, and the future of American manufacturing. After 2 days of intense talks in Geneva, May 11, 2025, U.S. officials declared substantial progress, calling it a deal that will help reduce the massive U.S. trade deficit. The agreement sets a 90-day window in which tariffs will be reduced. U.S. tariffs on Chinese goods may fall from 145% to 30%. China's tariffs on U.S. goods from 125% to 10%. Both sides also agreed to a new trade economic dialogue forum, but the fine print remains vague on tech exports, rare earths and long-term commitments. Here's the deep dive. 1. For U.S. consumers, fewer tariffs could mean cheaper goods, electronics, clothes, imports. That's positive. 2. For U.S. manufacturers and exporters, a reduced barrier for Chinese goods increases competition. For U.S. exporters, the pressure still exists. 3. For global power dynamics, this shows the U.S. and the Donald Trump strategy is shifting from tariff warfare to negotiation leadership. For key risk, this deal is temporary. Scholars warn we are still in a high tariff world, just a slightly less high one. This move comes as both economies face internal strain. The U.S. is battling high inflation and election pressure. China is struggling with slowing growth and massive capital outflows. Analysts note that holding the talks in Geneva, a neutral diplomatic hub, signals a genuine attempt by both sides to de-escalate. But experts warn that the interim deal is just a band-aid on a deep wound. Core differences, such as intellectual property, forced technology transfer, and market control, remain unresolved. Some commentators have suggested that the deal may bear the hallmarks of advisors close to Mr. Trump, who continues to embrace the mantra of deal maker. The big question is whether Washington is making a political move ahead of the upcoming election, when Trump remains at the center of every foreign policy debate. In short, the Geneva deal is a step forward, but it's not the finish line. Drop a comment below. Do you think you'll benefit from this deal or still be caught in the crossfire? The Federal Reserve is quietly pumping tens of billions of dollars into the banking system. Why? Because the U.S. credit engine may be sputtering, and when credit falters, the entire economy can feel it. Recent reports indicate the Fed injected approximately $29.4 billion in one day via overnight repo operations, the largest since the pandemic. Banks tapped the Fed's repo facility for $6.5 billion in a single day as repo rates spiked, signaling funding stress. Banking stocks in the U.S. and globally tumbled after investor concerns about credit quality surged. Bank reserves have hit their lowest levels in years, prompting experts to label this as a warning light for the financial system. Let's break it down. One for everyday Americans. If banks are stressed, they will increase borrowing costs or reduce lending. That means higher mortgage rates, tougher terms for car loans, or harder approval for a small business loan. 2 for the economy. When borrowing dries up, spending slows. That's a recipe for slowdown. 3 for the Fed. They're trapped to keep rates high, to fight inflation, or ease to support banks and credit. The game they're playing is fragile. Think of the Fed's move as a doctor giving a patient a saline drip. It keeps the patient alive, but doesn't cure the disease. When a supposedly strong economy suddenly needs emergency liquidity, it means something's broken inside. Liquidity stress suggests a lack of trust between banks or deeper funding problems. If not contained, we might soon see a wave of corporate defaults, especially with interest rates at a 20-year high and U.S. debt nearing $35 trillion. Each time the Fed pumps money, gold, Bitcoin, and tech stocks rally, investors are simply escaping from a weakening dollar. But these are short-term sugar highs before the crash. If the Fed keeps loosening, inflation could roll back, and the Fed will have to choose between saving banks or saving the dollar. And as always, when the system gets rescued, it's ordinary people who pay the price. Bottom line, good for traders in the short term, dangerous for the real economy in the long term. This is not a party, it's a warning. Bottom line, the Fed's action is urgent, but not openly declared as crisis. The question, is it a preemptive patch or an early stage of a bigger storm? Drop your comment. If you're a borrower, business owner, or saver, do you feel the credit squeeze or the Fed's move gives you relief? Like if you found this helpful, subscribe and hit the bell. Thanks for tuning in. See you next time.